So let's start off by just kind of explaining this general idea of not only what intangibles are, but really the separation between some of the external intangibles and the internal intangibles.
Hi, nice to be on the show. Yes, sure. There are indeed two types of intangibles, externally acquired ones and internally developed ones. The externally acquired ones are reported on the balance sheet, and they have indeed grown over time relative to company assets. Back in the 80s, they represented about 0% of company assets. Today, we estimate they represent about 20% of company assets. The internally developed ones, the one you develop within your company, those you don't report on the balance sheet, you expense the costs associated with them on the income statement, so you don't observe them directly, we have to estimate them. When we estimated them, what we found is that they have represented a steady fraction of company assets over time. Back in the 80s, they represented about 30% of average company assets in the US, and today they represent again about 30%.
Okay, so what's changing here at the moment? And does what people view as intangibles remain consistent, particularly in the areas that you have analyzed that remain consistent?
Whenever reliable equity premiums go through a disappointing period of performance, like value in the last 10 years, people naturally look for ways to tweak the metrics associated with capturing the premium, hoping that this will improve performance. At Dimensional, we believe that the efficient way to target reliably those premiums is to stay consistently focused on them. But that doesn't mean that we ignore the current arguments for the importance of intangibles, and that's why we conducted that rigorous deep dive into intangibles to see if you adjust your value and profitability metrics for intangibles, would you have gotten better, wider value and profitability premiums historically? And what we found is that adjusting for intangibles doesn't yield strong, compelling performance benefits. We didn't get consistently higher value and profitability premiums.
Can you explain the reason for the increase over time? You mentioned statistics from the 80s, 90s today. Why the growth?
So what we've seen a growth in is the externally acquired intangibles, the one you buy from other companies. Those have grown over time. The internally developed ones, they have stayed steady. And the important distinction here is that the externally developed ones, the ones that have grown over time, we do see them on the balance sheet, which means that they get reflected in traditional valuation metrics such as price to book. The internally developed ones, the ones we do not observe on the balance sheet, they are not reflected in traditional value metrics like price to book. Those have not grown over time. And perhaps because of that and all the noise associated with internally developed intangibles, there's no compelling benefit of trying to incorporate noisy proxies for internally developed intangibles in value metrics.
So, Savina, this raises a lot of questions, I guess, just about the way that a lot of factor investing is structured, this idea that you could sort of quantify a lot of these characteristics of a company and use that to place a very specific value on them. It's, of course, raised the question about quant investing and whether, I guess, not that it's not legitimate, but whether it's effective, I guess, as a longer-term strategy. I'm curious to get your thoughts on that. Does this sort of cause a little bit more reflection with regards to some of those quant strategies?
Yes, I think our study is unique in shedding light on all the noise involved in estimating systematically internally developed intangibles across companies over time, and showing that it's not easy. There's a lot of assumptions you have to make in order to estimate those intangibles, and there are issues with the quality and availability of the data you need to use. And that noise, perhaps, is the main reason why we don't see historically any benefit of incorporating internally developed intangibles in value and profitability metrics.
So what do you rate for? Is it all about, if you throw that script out and decide that it's not going to be about intangibles in any way in that particular specific area, what do you focus more on in this current time where we seem to be so out of whack with fundamentals at the moment? It seems to be pushing off growth ever further into the horizon. Where are you hanging your hat in terms of what is the key area of data to be focused on?
At Dimensional, we believe that it's really important to focus on portfolio design, portfolio management, and trading, all three key steps in the investment process in order to capture premiums effectively. We don't know when and where the value premium is going to show up. We expect it every day based on valuation theory. But in order to capture it effectively, you have to be very careful how you structure your portfolios, how you go about implementing them every day. Things like which variables you used. Are you using variables that minimize unnecessary turnover? What you do within a value strategy to pursue effectively the premium? Do you take into account interactions with other premiums? Do you look at your portfolio every day to make sure you stay consistent on the premium every day as company characteristics change with new information? And do you efficiently trade? Do you have flexibility in your daily implementation process in order to minimize unnecessary implementation costs? That's how we view kind of the key steps to capturing the premiums whenever and wherever they show up.
And finally here, just trying to think big picture, when you're going into a recession, and then of course when you're coming out of a recession, how do you think about these intangibles? If they're some of the last line items to get cut, if you're trying to cut expenses, or if you're some of the first investments to be made coming out, am I thinking about that correctly? Or how do you view intangibles as, from the company's perspective, how they view them?
It's hard to say that there are strong trends in terms of intangibles, spending on intangibles growing up or down during different economic cycles. We have seen, as I said, like steady, internal intangibles is a steady fraction of company assets literally from the 80s to the present, with no big spikes up and down during recessions or booms in that period. So going forward, the expectation is they're likely to stay a similar fraction of company assets as today, about 30% for internal and 20% for externally acquired. That's what we see today.